Hello everyone, my name is Colton Keeney, and today we'll be taking a deeper look into the specifics of the global financial phenomenon foreign direct investment, most commonly referred to as FDI. From countries just beginning to modernize to the richest countries in the world, the international business landscape is rife with opportunities for development. FDI is used by companies to gain specific advantages that exist in international markets that may not exist in their home country. Over the short life of this presentation, we'll examine the general definition of FDI, look at some of the theories that attempt to explain why firms choose FDI, and discuss both the historical and more recent trends of FDI. Foreign direct investment can be defined as the net inflows of investment to acquire a lasting management interest in an enterprise operating in an economy other than that of the investor. Most concretely, it may take the form of buying or constructing a factory in a foreign country, or adding improvements to such a facility in the form of property, plants, or equipment. FDI is calculated to include all kinds of capital contributions, such as the purchases of stocks, as well as the reinvestment of earnings by a wholly owned company incorporated abroad, and the lending of funds to a foreign subsidiary or branch. The reinvestment of earnings and transfer of assets between a parent company and its subsidiary often constitutes a significant part of FDI calculations. Portfolio investment, on the other hand, represents passive holdings of securities such as foreign stocks, bonds, or financial assets, none of which entails active management or control of the securities issued by the investor. Unlike FDI, it is very easy to sell off securities and pull out the foreign portfolio investment. Hence, FPI can be much more volatile than FDI. For a country on the rise, FPI can bring about rapid development, helping an emerging economy move quickly to take advantage of economic opportunity, creating many new jobs and significant wealth. However, when a country's economic situation takes a downturn, sometimes just by failing to meet the expectations of international investors, the large flow of money into a country can turn into a stampede away from it. The OLI paradigm, created by Buckley and Casson in 1976 and Dunning in 1977, explains how multinational enterprises choose FDI to serve foreign markets rather than alternative modes of entrance, such as licensing, joint ventures, strategic alliance, management contracts, or exporting, by describing the advantages that are needed to go abroad successfully and what advantages multinational enterprises seek to gain by using FDI. Ownership advantages must be present to successfully internationalize. Firms must have a competitive advantage that can be transferred from its home country to international markets. They should be firm-specific and not easily copied. For example, economies of scale and financial strength are not necessarily firm-specific because they can be achieved by many other firms. Location advantages, on the other hand, are usually what push firms into exploring FDI. They are typically market imperfections or genuine comparative advantages that attract FDI to particular locations. They can be cheap but productive labor, unique sources of raw materials, or centers of technological excellence. Lastly, internalization advantages are the key ingredients necessary to successfully implement an internationalization strategy using FDI. The possession of proprietary information and control of human capital that can generate new information through research allow firms to seamlessly move their operations abroad through FDI. Needless to say, research-intensive firms are most likely to fit this description. If a firm can minimize its transaction costs by moving abroad through wholly owned FDI, this will reduce the agency costs affiliated with asymmetric information problems between markets and a lack of trust amongst partners, suppliers, or financiers. Apart from the widely accepted OLI paradigm, Swedish economists have developed a behavioral model to determine why and how firms make FDI-based decisions. This approach is based on the phenomena that firms tend to invest first in countries that are not too far distant in psychic terms, such as cultural, legal, and institutional environments similar to that of the home country. This theory is most widely used when trying to forecast when and where firms already engaged in FDI will invest next. Historically, FDI inflows have been higher in developed countries than in developing countries. In fact, FDI inflows into developing countries were a third of total inflows in 2006, as opposed to the two-thirds of FDI inflows that went into developed countries. However, in 2008, the proportion of FDI tilted in favor of developing countries, as MNEs began sourcing facilities and operations in countries with higher potential for faster growth. and FDI inflows into developing countries rose to higher than half of total flows by 2012. When it comes to confidence, however, the A.T. Kearney FDI Confidence Index seen beside ranks world countries according to investor confidence. Although China ranked number 1 in 2012, it has now slipped to number 2 for 2 consecutive years. The USA, the historical FDI leader, has retained its position as number 1 in terms of confidence, with notables such as Canada, Brazil, and the UK trailing close behind. Although this index does not show exact FDI inflows, it does show confidence, which can be an indicator of future movements. As we can see in the graph on the side, the total flow of FDI is on the rise, approaching the 2007 all-time high. While the USA has managed to regain its top spot in the terms of investor confidence, actual numbers report the inflows into China were higher in 2013 than the USA, making them the number 1 spot for FDI. Most recently, the BRIC countries have managed to surpass both American and Chinese figures when regarded as a whole. In addition, the European Union, who accounted for nearly 55% of world FDI flows in 2007, has now not only dropped below other blocs such as the BRIC countries, but also below that of China, nearly neck and neck with the US.